All right, thank you guys for joining me. We had the return of Will's screen, which was very exciting. We have not had that in a while. He keeps saying he's going to update it, but it's not done yet. Anyway, welcome to today's webinar. So my name is Mark LaMonica. I look after the individual investor team here at Morningstar. Today we're going to talk about lessons from great investors. So hopefully things that we can learn from other people and then apply to our own investing. So first, our housekeeping items. So anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice, but I would like you to ask some questions, so send those through. And of course, for our friends over in New Zealand, you can find our FAP on morningstar.com.au, and the New Zealand Regulatory Authority encourages you to talk to a financial advisor if you would like personal advice. Okay, so let's get started. So yeah, you can put through the questions. There's a Q&A button at the bottom of your screen. There's also a chat function. So send through the questions. We had a good debate on Tuesday when everyone was offended by the things I was saying about the FIRE movement, or me equating that to a cult. So we'll see if we can offend some people today. All right. So what we're going to do is we're going to go through and look at and introduce a couple different investors and then talk about some lessons we can take from their investing career. But before that, one thing that we do want to talk about, overarching, is we're going to talk a little bit about edge today. So we've talked about edge before. Edge is basically what is it that you have as an investor that provides you with an edge over everyone else. And it's an important thing to think about, especially if you are actively going out there and picking individual shares or even funds and ETFs. So remember, people think that passive investing is completely passive. They're not making decisions, but they are making decisions. They're making asset allocation decisions, number one. And then they're already and they're making decisions about what funds and ETFs to buy. So I've already offended Matthew, so that is good. That was very quick. Yeah, you should meet me in person. I offend people as soon as I walk into the room. But that's good. All right, so one person's offended so far. We'll see what we can get up to. So we're going to talk about Peter Lynch. So this is Peter Lynch, oddly wearing a suit and what looks like snow boots. But we're not going to judge him for how he dresses. We're going to judge him for how he does as an investor. So a little bit of history with Peter Lynch. So Peter Lynch worked for Fidelity, and he has one of the best investing track records as a mutual fund in the US, or managed fund here, manager. So he ran a fund called Fidelity's Magellan Fund, and he ran it from 1977 to 1990. And when he started out, fund had $20 million in assets, but then of course he was doing well, and so investors invested a lot more money. So by 1983, so 6 years after he started, the fund had $1 billion, so 20 million to $1 billion, which is good. Now remember, that's not returns. We'll talk about returns in a second. That's just money flowing into the fund. It became the largest managed fund in the US with $13 billion in assets. So over those 13 years that he was running this fund, he delivered an annualized return of 29%. So that's really good. Really, really, really good. 29% a year for 13 years is incredible, especially given the fact that that fund grew so big, because it's a lot harder, of course, to manage a bigger fund. There are less shares you can invest in at the end of the day because it's harder to buy very small companies. And yeah, you always have this money coming in that you have to continually invest. So he wrote two very famous books, One Up on Wall Street and Beating the Street. They're both very good. So something to read. So let's try to take some lessons from him. Uh-oh. Echoing. No sound. Okay. Sorry if people can't hear me. You're not missing much. Trust me. All right. So what are some things that we can take from Peter Lynch? So I think Peter Lynch is a good example, and what his books are about is talking about understanding and knowing what you own and why you own it. So, this kind of equates to what you hear Buffett talking about a lot, which is circle of competence. And circle of competence is a Buffett term to talk about. What he talked about is that he's going to invest in businesses and companies that he knows and understands. Now, this comment that he made about circle of competence, people used that to criticize him back in the late 90s because Buffett didn't invest in tech stocks because he said, I don't really understand them. Now, he's changed his tune a little bit since then, but he said he didn't really understand them and he wasn't going to invest in something he didn't understand. And a lot of people use that to, of course, go after him and say that he was washed up and, he was an idiot and is missing out on all these returns. Well, then the dot-com bubble happened. And yeah, people stop saying that about him. But anyway, why do we want to understand Circle of Competence? And we're actually recording a podcast episode later today that talks about this. But why is Peter Lynch saying know what you own, understand what you own? Because we need to acknowledge that as investors, if we are picking individual shares, or even if we're picking funds and ETFs that are narrowly focused, the first thing is we need to look at an industry, right? Because what are we trying to do as investors? We're trying to find a great company. And a great company, of course, is a company with a moat, so it has a sustainable competitive advantage. The only way we can assess that is if we really understand the industry, because we need to understand the competitive dynamics of the industry. There are different moat sources that apply to different industries, and I'll give it an example in a second. Talking about knowing what I own, we'll talk about liquor companies, but yeah, you need to understand that industry. You need to understand the competitive environment to then assess companies and how they're going to do. So let's give a little bit of an example. And there's a quote from Peter Lynch, which I think is good around this, is right here. Behind any stock is a business. Find out what it's doing. So let's talk about this, and we'll use an example, and we'll look at the liquor industry. So that's my joke about me drinking too much and understanding the industry. But the liquor industry has very specific moats, so very specific attributes that companies would need to do well in it. And what those two moats are in Morningstar speak is intangible assets and cost advantage. So intangible assets, in this case, refers to brand. So a brand, an intangible asset, is something that is not held on a balance sheet. Those are tangible assets, like a building. That's an asset on a balance sheet. An intangible asset is something that's not held on a balance sheet, like a brand. And the other thing is cost advantage. Let's talk about brand first. So if you understand how the liquor industry works, you understand that people walk into pubs and they walk into bottle shops and they're looking for specific brands. Brands are very important in the industry. So having very strong brands matters. So if you walk in and you want to buy Jack Daniels in Sydney, or you want to buy it in Europe or the US, it's all the same, right? You know what that is. So that brand is really important. So to do well in the industry, you need a brand. The other thing is that because we have these global brands, cost advantage, so the ability to produce things cheaper, is very, very important. So understanding that industry allows you to start making these insights and allows you to assess companies within that industry. It's also important to say that every industry is not the same. So there are some industries that are naturally much more technical and complex. So I use an example of one that hopefully most people can relate to and that they understand. Just like any sort of kind of consumer good, mass consumer good, it's easy for us to understand because we generally consume it, right? If we go into Kohl's and go to the toothpaste aisle and we're looking at Colgate and different brands, like we sort of understand that, right? There are other things that are a lot more complex to understand. And this is what Buffett's talking about. Some of this cutting edge technology, biotech companies, a lot of the resources as well, which have very different supply and demand factors that influence them. Those are industries that are more difficult to understand. So one lesson is think about what you understand, what you can grasp. So a lot of people like to invest in the same industry they work in because they've obviously built up an understanding about this. But I see people all the time telling me about, biotech trials and these different drugs on trial. And I know they don't know anything about this. So think about that, thinking about really understanding the business. Because if you understand the business, you understand the industry, you can start making judgment calls on how different shares are going to perform. The other thing that Peter Lynch has, which is sort of this first quote, a lesson we can take with him, is why you own it. A lot of people don't understand why they own certain investments. You should be able to answer that question. And the answer to that question should not be because it went up, which is what a lot of people say. Why do you own this weird little thematic ETF? Oh, it's gone up. Okay, well, really understand why you own it. And, a good lesson that he talks about, that Peter talks about in his books, is write stuff down. And we've said this here before, writing stuff down, or even going and pitching it to somebody, so your partner or a friend, pitching why you want to buy a stock, why you want to own the stock, is something that's pretty effective too, because it forces you to actually think about it. Instead of these kind of vague notions in your mind, oh, it's, this is something I should buy, when really all you're doing is chasing performance. So writing stuff down is pretty important as well. Those are some lessons from Peter Lynch, and also lessons in dressing. I mean, he lives in Boston, so to be fair, it could have been snowing this day, I guess. I mean, maybe it's a little bit of a different look, and we've got the kind of 80s style baggy suit. But yeah, we're not taking fashion tips from him, and I should not be talking about fashion. But all right, another person we should not be taking fashion tips from is Hetty Green. So Hedy Green is probably less well known. Her unfortunate nickname was the Witch of Wall Street, so not very endearing. But yeah, this is Hetty Green. So basically, Hetty Green was one of the most wealthy women ever. So she was lived in New York during the late 19th century. So when she passed away, she had a $100 million fortune. So that's $2.3 billion today. And so one of her contemporaries that probably everyone has heard of is J.P. Morgan. Obviously a very prominent banker, lived during the same time. When he passed away, he only had $80 million. It's still a lot, but just gives you an idea of the fortune that she amassed. And people obviously didn't really know what to do with her. She dressed all in black, and reportedly was not the nicest woman in the world. But what she teaches us is a couple things. Obviously, we've got this simple: buy cheap, sell dear. Buy low, sell high. Whole adage. But the other thing that we can get from her is holding cash. So one of the sort of biggest wealth building times in her life was something called the Panic of 1893. So what happened? Well, periodically, back before there was more regulation in the banking system, there were these panics where everyone would think the bank was going out of business. If the bank goes out of business, you lose all your money in the bank. So you pull all your money out of the bank. The bank pulls in all the loans that they have. Generally not good for the economy. So yeah, there were 15,000 bankruptcies in the Panic of 1893 in the US. And yeah, there was no money. So guess who had cash? Hedy Green. So we all think very negative things about cash, particularly in this interest rate environment that we're in now. And that is fair. But yeah, cash does have advantages, and the advantage is it allows you to take advantage of opportunities. So that's something we can take from Hedy Green. So what did she do? Well, she had a bunch of money, so she loaned out millions of dollars to individuals and businesses, and she made them put up for collateral property. Now, a lot of them didn't pay her back, so she took their property, and she became this huge property owner. So it was estimated at her death that she owned 8,000 different properties across the United States, which is pretty crazy. So hotels and office buildings, and she owned some churches, which is interesting for the witch. But yeah, she owned all these properties, and we should think about cash as not just a drag on performance, although it is, but also something that allows us to take advantage of opportunities when they arise. So it's something that you can do. It is an edge that you can have as an individual investor that a lot of professional investors can't. So a lot of professional investors, there are exceptions, a lot will not hold cash if they run a managed fund. And whether that's right or wrong is a big debate, but it's something you can do is have reserves so that when there are these giant buying opportunities, so like we saw in the GFC, like we saw after the dot-com crash, that's when you were able to take advantage. And not to keep talking about Warren Buffett, but Buffett's the same way, right? So Berkshire has this enormous cash reserve. And what did that allow them to do? Well, in the GFC, it allowed them to make very, very good deals with companies like Goldman and GE who needed cash. And they were able to go out and basically get preferred shares. If you go back and look at the history, that they then converted into common shares at very cheap prices, because during times of panic, cash is king. So if you have it, you have an advantage. All right, this is Sir John Templeton. Now, his shoes are not viewable, obviously, in this photo, but I bet you he's not wearing boots. Okay, so let's talk a little bit about Sir John Templeton. So he was a British and American, he moved over to the US, investor and fund manager, and he started this fund called the Templeton Growth Fund. And Money Magazine named him arguably the greatest stock picker of all time. And what he was known for is doing things, as you say, doing things that are different from the crowd. So that's another important thing to remember, that average, if you want to be an average investor is an index fund, and that is not a bad thing. So it's important to realize that that's not a bad thing. Doing average is very good. Doing average has been very good for investors. But if you are trying to, if your goal is, and this helps you reach your goals in life, if your goal is to beat the market, you have to do different things. You can't just do what everyone else is doing. And so what did Sir John Templeton do? He started investing overseas. So back in the 50s and the 60s, when this wasn't really done, he started investing outside of the US, particularly in Japan. Yeah, everyone told him he was crazy for doing this. Why would you ever invest in Japan, for example? Well, Japan, obviously, up until what happened with the Nikkei crash, did very, very well. So that is a lesson we can take from him. Also, is he basically did the same thing that we talk about in that acid passive barometer report, which I'll get to in a second. What he did is he invested in areas where it was easier for him to have edge. And so this is what we talk about all the time, and we're looking at active managers versus passive managers, that active managers do better in corners of the market that there aren't as many investors looking at it, right? And that makes sense, right? The more competition there is to go in there, if you're looking at large cap US stocks or large cap Aussie stocks, there's a lot of competition. A lot of people are buying those, a lot of people trying to analyze them. But if you go off in obscure parts of the market, so small cap stocks, investing overseas in different countries that aren't followed as much, like emerging markets, there is the opportunity for you to do better. And that's where we see active managers do better. Now, there's all sorts of problems by this and all sorts of reasons why this may not be appropriate for you as an individual investor, because, yeah, there's more risk, but just something to think about, that if you are out there actively picking stocks to try to beat the market, think about where you're looking and what that opportunity set is and who you're competing against. All right, we're rolling here. Will's making noises. Oh, text messages. People are wondering where you are, Will. It's like I'm listening to another one of these boring webinars. All right. Our next investor. Once again, we're talking about edge here. In this case, we're talking about long-term edge. So who are we talking about? So Seth is an American billionaire. So he's a hedge fund manager and an author, and he is a big proponent of value investing. So obviously, struggling a little bit right now with the environment that value is in. But yeah, in 2008, he started a hedge fund. And $27 million, which is what was in his hedge fund up in Boston, the Baupost Group. And so, yeah, he starts out in 2008, and then he has gotten 20% returns, and he's up to $27 billion right now. So, yeah, pretty good. Now, he's talking about long-term. So let's think about long-term. It's another huge advantage that we have as individual investors over professional investors. So every professional investor will tell you that they're a long-term investor, of course, because you kind of have to say that. But a lot of them aren't. And a lot of them aren't for very specific reasons that doesn't influence us. And basically, that's pressure. It's the pressure to keep up with their peers on a quarter-to-quarter and year-by-year basis. We don't have any of that pressure as an individual investor. So any pressure we put on ourselves to have a short-term mindset is just stuff that we're doing to ourselves. And the reason that professionals have to do this is, of course, because of bad habits we have as investors, right? We chase performance. So professional money managers, professional managed fund portfolio managers know that if they continually underperform, that all the money is going to go away. If all the money goes away, the firm makes less profit. That's career risk for them. So what they do, and this echoes back to what Templeton said, what they do is very closely mirror each other and the indexes that they're following, right? So it's kind of that old adage that, it is better to be wrong with everyone else than to go out on a limb, right? So, there's safety in crowds, and that's basically what they're doing. So something that's important to keep in mind that we learned from Seth is to keep that long-term orientation and just realize that as humans, we have an action bias. We always feel like we need to do something, right? We need to respond to different events, respond to different things. Most of the time, the best thing to do as an investor is do nothing. So not do nothing like don't invest, but do nothing as in do not overtrade, do not spend too much time going in and tinkering with your portfolio and feeling like you need to respond to every new piece of data that comes out there. So something that's important. And if we think about compounding, right? So there's two kind of layers of compounding. There's a layer number one of letting your investments compound, letting them earn returns on returns. The other thing is that once you've found great businesses, and if you're focused on finding great businesses and businesses that have a competitive advantage, let that competitive advantage compound because it's not overnight, right? Like the way that a moat works and the way that a company that has a competitive advantage works is a couple different things are going to happen. Number one, they're going to earn outsized returns on assets and capital. So any money they invest back in the business, they're going to earn a return that's significantly above the return or the cost of capital that they have. But that takes time, right? So what that means is I can go out there and borrow money for 10% and invest it for 20%, right? Like that's very, very powerful. Where many businesses go out and borrow money for 10% and maybe get a 10% return, maybe an 11% return, right? And they can be a going concern by continuing to sort of recycle money through the company as they invest more money, they earn a return, just not an outsized return over that cost of capital. But if you are a company with a competitive advantage and you're earning those outside returns, over time that will compound. So let the business do the work, which is another quote by Seth. And so, yeah, we all know this, right? We were told this and everything. Don't compare your results to others constantly, which is what he's saying in here. Just like don't compare your life to everyone else's all the time, because obviously the picture of their life that you're getting is probably not accurate. So same thing with investing. So, a lot of people I know will sit there and maybe won't pay too much attention to their portfolio or maybe a lot of attention, but they'll just start thinking about, oh, what could have been? So, you've invested in X, what if you would have invested in Y? And all of this just sort of feeds in that action bias that you feel you have to do something that you're missing out. So a good lesson from Seth. All right, our last one. We're doing well. So if people do have questions, we don't have as many questions today. Maybe I've timed these things because we've had too many questions. The last one, I haven't gotten to them all. All right, our last investor is Henry Singleton, this guy right here. So he was a CEO. So anyone who's read the book, The Outsiders, which is a really, really good book, talks about sort of corporate leadership and capital allocation, but it is a good investing book so that you can start thinking about, okay, what is it about a business that makes it great? What are the leadership qualities? And it focuses on, I think, 8 different CEOs. What are those leadership qualities and how do they make capital allocation decisions? So decisions on what to do with your money as an investor, right? But how do they allocate money in the business? Do they reinvest it in the business? Do they give it back as dividends? Do they do share buybacks? So Henry Singleton is one of the people focused in this book, The Outsiders by Thorndike. So yeah, I like his little quote. He's basically sitting there and saying that, he reserves the right to change his mind. So there are other quotes about this that, as certainly the facts change, your opinion should change. That's not true for a lot of people, right? They get stuck in the same approach. So no matter what happens, the answer is the same thing. So anyway, he ran this company called Teledyne. It's still around. They make one of their things is airplane instruments. So things that would go in cockpits and stuff like that. But yeah, he ran this company Teledyne for 30 years.
And so he took the company public. So his initial investment, he was one of the founders, was $450,000. And at the end of his 30-year run, they had annual sales of $450 million, which is pretty good, and had a market capitalization of $1.15 billion. So his big focus was capital allocation. And sort of he saw his job as CEO is really making that decision, which he thought was very important. So he had a very unusual approach. So first, let's talk about a really unusual approach to share buybacks. So we've talked, and I think I confuse people by being confusing. So we've talked about share buybacks before. So of course, a share buyback is when a company goes and, instead of issuing new shares, they're actually buying those shares back and retiring them. So the theory behind this, of course, is that you are shrinking the number of shares. That means for every shareholder that's still out there, or every share that's still out there, they get a bigger share of the company, right? So, simple example, if a company makes $100 and there are 10 shares, you know what you get, right? You get $10 a share. $10 a share of earnings is sort of yours. Now, all of a sudden, if there are 5 shares, well, now you get $20 worth of earnings. So buying back shares, reducing that share count is positive. Now, the way that this is typically done, and this is where I think I was confusing, the way that this is typically done is a lot of companies now will just have these long-term share buybacks. And you'll sort of see them get announced, and they'll say, okay, we're buying back $10 billion of shares over the next 3 years. And they sort of continually sit there and just buy back shares. No matter what the price is, no matter what's happening, it's just sort of what they do. And a lot of these companies, not all, but I'll say some of these companies are just doing this to keep their share count steady because they're issuing shares in other ways. Excuse me. And a big way that they issue them, of course, is compensation. So I found an example. We'll use Facebook. So people probably heard of Facebook. All right, in 2020, Facebook bought back $6.2 billion worth of shares. So that's a lot, right? So they spent $6.2 billion. So somebody made that capital allocation decision that they were going to spend $6.2 billion to buy back shares. Now, they could have done anything with that, right? They could have bought another business. They could have hired more people. They could have given that to shareholders as a dividend. But they didn't. They bought back shares. So at the beginning of the year, beginning in 2020, Facebook had 2.88 billion shares outstanding. At the end of the year, they had $2.9 billion shares outstanding. So what happened? Well, what happened is that $6.2 billion, despite the fact that they spent that on buying back shares, their share count still grew because most likely they were issuing those shares as compensation, which is fine, right? You need to pay people and you need to retain talent. But just my point is that some of these share buybacks are not as great as they seem. So, people that have this fantasy, okay, $6.2 billion, that's awesome. They're going to reduce share count by a lot. Sometimes that doesn't happen. But very different approach with our friend here, Henry Singleton. So he only bought back shares during certain times. So he thought there's no point in buying back shares if the share price is doing really well, like Facebook's had. I'll only buy back shares when it makes sense, when it's really cheap. So 8 different times over his 30 years, he made very large buybacks. So we'll go through one example. So in May 1980, so the market's not doing very well, Teledyne's PE ratio was the lowest it's ever been. So the price to earnings ratio, indicating that it could potentially be cheap, was the lowest it's ever been. So that's a relative valuation technique. He's comparing it to historic PE ratios, so how much somebody would pay for a dollar of earnings. Very, very cheap. So he started a tender offer. Now, tender offer is a very different way of buying back shares. Instead of just slowly buying back shares over time on the open market that nobody really notices, they're just out there just like any other buyer of shares, just buying them and retiring them. Tender offer is when you say, okay, at this specific point in time, I am going to buy back shares for this much. So he put out this tender offer saying that I want to buy back X amount of shares, and it was oversubscribed by 3 times. So basically 3 times more people than shares he wanted to buy back said that they wanted to sell the shares to him. So he decided to do it all. So he just did it all. So he bought back in one single event 20% of the outstanding shares. So he basically took 20% of those shares and retired them. Now, of course, when this was oversubscribed by 3 times, he sat there and said, okay, well, we don't exactly have the money for that. So he went out and he funded the entire purchase with fixed rate debt. And he did that because the company had really strong cash flows. And he did that because interest rates had recently dropped. Now, they were at a staggering level compared to what they are now. But at the time, they had recently dropped. So he went out there, financed the whole thing with fixed rate shares. Then interest rates went up right after he did this. So talk about timing this great. So because they went up, the next thing he did is he went back there and he bought back all the debt. So he used cash to buy back the debt. And he did it in a very specific way by giving the debt to the pension fund and then buying it back. So the pension fund made a profit on the debt. And because, of course, of what's happened with interest rates, because he just gave it to him. So yeah, very savvy guy. So anyway, the example here that we all need to realize as investors is that if we understand how things actually work, and this is very different from knowing something, right? Really understanding investing, really understanding the different things at play in the market, we can take advantage of changing our approach based on different market conditions and how they change. Well, thank you guys for joining, and please send me an email if you have any questions. So mark.lamonica1@morningstar.com.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.